Hello and welcome, everyone. Our speaker for today is Jason Zweig. Jason writes a weekly column, The Intelligent Investor, for the Wall Street Journal. It's a very, very popular column. He's also going to be speaking about this book, The Devil's Financial Dictionary. So I'm not going to give away more on the subject of that book, though. But it's very interesting about, if you look at the array of subjects that Jason has written about over the last 30 years, he's written The Little Book of Safe Money, an investing guide. He's also assisted the Nobel Prize winning psychologist Danny Kahneman in writing his book, Thinking Fast and Slow. Daniel Kahneman, for those of you that know, gave a fantastic talk at Google some time ago. And Jason frequently speaks to CFAs, investors, students, journalists. So in talking to him before the talk, I was asking him, hey, when did you get your CFA? And he said, I don't have one. And I said, do you have a CFP? He said, no. And I said, well, at least tell me you have an MBA. And he said, no. And I found that pretty interesting. And I guess, he might talk more about, why or why not that is a good or bad thing. Jason is guided largely by a saying of his father's. It's remarkable how much you have to learn in order to realize how little you need to know. It also brings to mind what Einstein said, which is when he mentioned education is what remains after one has forgotten what one learned in school. So without further ado, ladies and gentlemen, please join me in welcoming Jason Zweig.
Thank you, Saurabh. Thank you, Saurabh, and it's my pleasure to be here. Like, I think everyone who writes and researches for a living, Google has been an enormous help to me over the years, so I think turnabout is fair play. I'll try to give you some useful ideas today, and of course, for the folks who might be tuning in later on YouTube, welcome to all of you, and thanks to everybody for coming today. So I'm going to talk about my new book, The Devil's Financial Dictionary, but I'll also talk a little bit at the end about my role in editing the Benjamin Graham book, The Intelligent Investor. And as many of you know, Graham was probably the greatest investment advisor of the 20th century, the founder of the modern discipline of security analysis, Warren Buffett's teacher, and it was certainly one of the great honors I've had in my career to be involved in editing his book, The Intelligent Investor. So this is The Devil's Financial Dictionary, and it was inspired very directly by The Devil's Dictionary by Ambrose, Bierce, and thank you, Google Books, if we have anybody from Google Books in the room. This is the title page. The book first appeared in its final form over a century ago, and many people would regard it as one of the funniest books ever written in the English language. I'm among them. And this is Bierce. He was born in 1842. He is believed to have died in 1914, although no one really knows for sure. He is believed to have died when, weary of human folly, he walked across the border into the Mexican Revolution, hoping that he would be shot. And no one really knows what happened to him after that. But he did not suffer fools gladly. And here are a few examples of definitions from the original Devil's Dictionary. This is probably his best known definition. Those of you who are married, Saurabh, perhaps you can sympathize with this. Love, noun, a temporary insanity curable by marriage. Another favorite of mine, once you are in love, you should remember this. Jealous, adjective, unduly concerned about the preservation of that which can be lost only if it is not worth keeping. Here's one of his few financial definitions that's quite good. Finance, noun, the art or science of managing revenues and resources for the best advantage of the manager. And I've included this one. It gives you a sense of how dark Bierce's view of the world was. I don't really endorse his pessimism. You can draw your own conclusions about his personality. But I put it up because those of you who buy the Devil's Financial Dictionary will encounter some definitions that I've written that also feature these little, I call them flights of fancy, in which an imaginary character explains, helps us understand a definition. And in this case, Bierce is giving us two lines of poetry from a non-existent medieval English poet named Borri the Bald. But in any case, so why did I want to write this book? Well, some of you might be familiar with the 19th century British essayist and historian Thomas Carlyle, who is today perhaps best known for saying that economics is the dismal science, which is a little quip that he made in an article he wrote, I believe, in the 1840s. And what I would argue after almost 30 years of writing about investing is that if economics is the dismal science, then investing is the abysmal art. It is rendered boring and overly complicated. A few words I've heard over the years about various investing books are some of these. I'm sure anyone in this room who's read a book on investing might have adjectives of your own you would tend to apply. But it's never really been clear to me why there's no sense of fun involved when we talk about investing. And also why so few people point out the ridiculousness and the absurdity that often is involved when people manage other people's money. So that's some of the spirit I wanted to get at in the book. And the other thing is, it occurred to me as I was thinking about recapturing some of the spirit of Ambrose Bierce, that maybe if you can make people laugh, you can help them learn. And I think one of the real pitfalls of traditional financial advice is it's so somber and deadly serious and sort of self-referential and often self-righteous. And one of the things I've learned over the years is that, yes, it's true. In the very long run, financial markets and the returns on investments, they're driven by economics, the fundamental forces of supply and demand. But in the short term, the medium term, even the fairly long term, for many years on end, 3 to 5, sometimes 10 years, markets are driven by psychology, often crowd psychology, sometimes abnormal psychology. And another wonderful thing that a satirical dictionary format enables a writer to do is to look at etymology, the derivations of words. Because often one of the things we pick up when we learn where words come from is the hidden meanings that kind of lurk within the heart of terminology we use every day without really being very aware of it. One simple classic example is, and I'll ask, does anybody in the room know, what do the words happy, happen, and perhaps all have in common? Does anyone know what the root word hap means in early English?
Chance.
Exactly. Means luck. So remember, the next time you're happy, which I hope will be in a couple minutes from now, remember that you're happy because you're lucky, and to some extent, to be lucky is to be happy. So I wanted to have some fun with ideas like that. But it's also, I wanted to bring in financial history, because one of the critical things investors need to do is learn from mistakes. Now, we can learn from our own mistakes, but it's a lot cheaper to learn from other people's mistakes, right? And a really simple, useful definition of history is it's the record of other people's mistakes and also their regrets. So we can learn from that. And then the final thing that I think satire is useful for is to fight confirmation bias, to prevent us from digging ourselves into an ever deeper hole of our own decisions and just constantly drilling down to prove that what we've already done is right, and just to sink into this sinkhole of our own sunk costs until we can't get out. And if you can bring a little sense of play and make a little bit of fun of people's ideas, maybe you can jolt them out of that complacency. That at least was my hope. So I'm just putting up one illustration from the book just to give you a sense of the feel that the publisher and I wanted to get across. Some of you may recognize this is a 16th century Dutch engraving taken from a painting by the great Dutch master Peter Bruegel the Elder. And this was engraved around 1558, and the queenly character sitting in the middle is Avaritia, or greed. And you can see all of these people and creatures are worshiping her, serving her in one form or another, filling her chest with gold. Her lap is full of gold. There's a frog in the foreground, or it might be a toad. Frogs and toads were symbols of greed in medieval Europe. And there are all kinds of other things going on. And at the risk of bothering people who are eating their lunch, I'll point out that on the far right, a stork is feeding from the bottom of that figure immediately to the left. And so I wanted to give you a few of the definitions in the book, just to give you a feel for what I'm trying to do. And those of you who are in the market for financial advice should probably keep these first two in mind. So, big producer, noun, a stockbroker or insurance agent who produces big commissions. The term is erroneous, however. The broker or agent doesn't produce the commissions. It is his clients who produce them. He just collects them. So then, financial advisor, often someone who cares deeply about being prudent, diligent, competent, and honest, in which case his or her services will be priceless. Sometimes, someone who cares only about being a big producer, in which case you are in for big trouble. This is one of my favorite definitions. It's very short. Potential conflict of interest, noun, an actual conflict of interest. Every prospectus you read, every document your financial advisor might hand you will mention this term, potential conflict of interest. And you should remember that the real meaning is actual conflict of interest. Forecasting, noun, the attempt to predict the unknowable by measuring the irrelevant. A task that in one way or another employs most people on Wall Street. Because the human mind hates admitting the truth that the world is largely random and unpredictable, forecasters will always be in demand, regardless of their futility. Wall Street follows what marketing professor J. Scott Armstrong has called the seersucker theory. For every seer, there is a sucker. In the real world, as with weather forecasts or predictions about who will win a sporting event, those making the projections typically estimate the likelihood that they are correct. Wall Street forecasts, on the other hand, almost never have probabilities attached. As decision scientist Baruch Fischoff wrote in 1994, when both forecaster and client exaggerate the quality of forecasts, the client will often win the race to the poorhouse. Long-term is another favorite of mine, and I think it's one that's very useful for people to bear in mind. Long-term, adjective. On Wall Street, a phrase used to describe a period that begins approximately 30 seconds from now and ends at most a few weeks from now. Now here, I've put up one of my favorite images. This is a clay model of the liver of a sheep from ancient Babylonia. It was made sometime between 1900 and 1600 BC. So it's well over 3,500 years old, almost 4,000 years old. And here's the definition. Baru, noun. In ancient Mesopotamia, a priest who specialized in predicting the future by studying the contours of a liver or lung taken from a sacrificed sheep. The Baru worked from an intricate template, often rendered as a clay map that charted dozens of variations on the surface of the sheep's organ, as in this example from the British Museum. We may safely presume that when the Baru's predictions didn't come true, he blamed it on the dead sheep. The modern version of a Mesopotamian Baru is known as a technical analyst. This is another illustration that I love. This is from a 15th century British manuscript, and it might look a little mysterious to you, but I think you'll understand when I read the definition. Bonosus, noun. A mythical creature described by the ancient Romans and often included in medieval bestiaries, the bonosus closely resembles a bull, but with its horns curled back toward its tail. Because the horns are only for show, as the Roman naturalist Pliny wrote, the bonosus has no way to deter predators and will run away as soon as it is threatened. When it becomes panic-stricken, the bonosus spews immense quantities of flaming hot manure in its wake. As the next stock market crash will show, the typical investor who believes himself to be a bull will turn out to be a bonosus. Do not stand too close behind him. Irrational, adjective. A word you use to describe any investor other than yourself. So here I have a little set of some of the behavioral finance definitions in the book. They form a little bit of a theme, as you might imagine. Overconfidence, a belief unjustified by the evidence that one knows more or is better than others. The predominant personality trait of most investors and nearly every amateur trader. To be overconfident is to be ignorant of your own ignorance. In the financial markets, overcoming overconfidence is essential and extremely expensive. Bull. Noun, a person who believes that an asset will go up in price, a belief often based exclusively on the fact that the person happens to own it. A bull in full stomp is almost incapable of absorbing any evidence suggesting that the asset might go down instead. Bull market, noun, a period of rising prices that leads many investors to believe that their IQ has risen at least as much as the market value of their portfolios. After the inevitable fall in prices, they will learn that both increases were temporary. And this one is very important, and we'll circle back to this when I talk about Benjamin Graham toward the end. Career risk, noun, the risk that by thinking independently, a money manager might lose clients, endanger a big salary, and harm his or her career. For money managers, the only risk that matters. When professional investors are right, no one will ask why. Their clients will be too busy counting their profits to seek an explanation. But when money managers are wrong, their clients will immediately want to know why they made the mistake. Portfolio managers can either be wrong in a crowd, in which case no one will blame them for making the same mistake everybody else made, or wrong and alone, in which case they will look like idiots. Option, noun, sorry, hang on one second. Like everything in life, this is a little harder than it looks. Option, noun, the right to buy or sell a financial asset at a fixed price on or before a specific time, from the Latin optio, I choose. A boon for stockbrokers whose clients don't understand how options work and generate a fortune in commissions as they attempt to learn. And here I have a little flight of fancy. Explained, Hugh asking me, a client of the brokerage firm Born Rich and How. I put 2 children through Harvard by trading options. Unfortunately, they were my broker's children. Perhaps the earliest recorded options trade, according to Aristotle, was made by Thales of Miletus, circa 624 to 547 BC, one of the 7 sages of Greece, who put down deposits on all nearby olive oil presses one winter, when his knowledge of astronomy purportedly told him that the next year would bring a good olive crop. Thales paid almost nothing and profited hugely when the abundant harvest created high demand for presses, thus making him one of the first individual investors to make more money trading options than his brokers did. He was also one of the last. Now, obviously, I have to remind all the Googlers that this refers to exchange-traded options rather than incentive options. Broker, the comparative form of broke. Also used as a noun, a person who buys and sells stocks, bonds, mutual funds, and other assets for people who are under the delusion that the broker is doing something other than guesswork. One early definition of a broker, sometimes attributed to the British lexicographer Samuel Johnson, is a negotiator between 2 parties who contrives to cheat both. And here I'd like to show you this wonderful, although maybe not so tasteful, engraving from 1720, which illustrates the South Sea bubble and the various other speculations that swept through Europe at that time. And these are 2 brokers who are distributing securities. You can see that hostility to the financial industry is not exactly a contemporary phenomenon. This is almost 400 years ago. Panic, noun and verb. Contagious fear that sweeps across a crowd, a market, or a planet, frightening multitudes of people into selling and leaving the rest wondering whether they should. Like swarms of cicadas, long ago there were panics roughly every 17 years. In 1819, 1837, 1857, 1873, 1893, and 1907. The word derives from the god Pan, who haunted the pastures and wild places of ancient Greece. In the form of a grinning but ugly man with the horns, ears, and hairy legs of a goat, Pan was the god of herds and flocks, serenading them with his pipes. Fittingly, Pan was the son of Hermes, the god of shepherds, messengers, diplomacy, travel, trade, and thievery, suggesting that the relationship between panic and trade is as old as commerce itself. And this illustration comes from September 1873, immediately after the panic of 1873 that swept through Wall Street. And the caption is "Panic as a health officer, sweeping the garbage out of Wall Street. New York, only a few years earlier, had been subject to several cholera epidemics that were believed to have been caused, very likely correctly, by the abundance of garbage in the streets, including horse manure and other things. And so sanitation workers were organized and hired by the city, and these sweeping crews would go through. But here, what the artist has done very cleverly is he's transformed one of them into the Greek god Pan to symbolize the financial panic that had just struck. Risk, noun. The chance that you don't know what you are doing when you think you do. The prerequisite for losing more money in a shorter period of time than you could ever have imagined possible. Risk can be formally defined as the odds of an adverse or undesirable outcome. When the forecast is for an 80% chance of sunshine, for example, then the risk of rain is 20%, or as the extent to which extreme outcomes differ from the average. It has been philosophically defined by finance professor Elroy Dimson of London Business School this way: risk means more things can happen than will happen. In the end, risk is the gap between what investors think they know and what they end up learning about their investments, about the financial markets, and about themselves. Stock, noun, the right to own a fraction of a business, regarded by most investors as the right to play a video game. So that gives you a taste, I think, of some of the definitions I have in the book and how I hope using a little bit of a forked tongue might help shock people out of accepting things at face value when they're dealing with the financial markets. And here, just getting back to the idea of disconfirmation, are a couple of quotes from Warren Buffett and his business partner, Charlie Munger, about Charles Darwin. And I think the main thing I learned in working on this book is how hard it is to mock an idea and to poke fun at it fairly if you don't know what you're talking about. In order to hit the target and to find the humor or the absurdity that's lurking at the heart of an idea or a marketing pitch or any other investing concept you might be confronted with, you have to understand it pretty well. Because if you poke fun at it without fully understanding it, it just comes across as mean. And so far, in the 3 months this book has been out, I haven't had anybody on Wall Street complain to me that I was unfair. In fact, a lot of investment bankers and fund managers have said to me, "Oh, you were way too nice." So I think there's an important lesson in this, which is it can be quite useful for you as individuals and maybe as members of an organization. Before you commit to an idea, an investment, a project, or a significant new initiative, it might be worth privately seeing if you can ridicule it first. What's funny about it? What makes no sense? And I think that can be a useful mental exercise. I would run that past my supervisor before I tried it if I were you, but I think there's a lot of wisdom that can come from trying to find the absurdity, the humor that's lurking inside an idea. Believe me, it's much better to do it in advance, beforehand, than to find out after the fact that what we just spent all our time and money on was ridiculous. So let me talk for a few minutes about the intelligent investor. In 2003, I had the great honor of editing the book, and I learned a great deal from doing that. Benjamin Graham was born in 1894. He died in 1976. He was one of the most successful investors of the 20th century. And interestingly, he spent a great deal of time in the first edition of the book on this question. You know, what makes an intelligent investor? And he took great pains to emphasize that it's not the kind of intelligence that we might normally associate with intelligence measures. It has nothing to do with IQ or SAT scores or GREs or any other standardized test. It also doesn't have anything to do with credentials. And he was very specific what he meant. As he put it, it's a function more of character than intelligence, as most people define it. And he also, throughout his writings, enables us to see what he meant by character, what makes that kind of intelligence. And these are critical virtues for anybody who wants to succeed as an investor, regardless of what investing approach you take. So you have to be patient, you have to be prudent. It's very important to be independent and skeptical. That's at the heart of everything. You have to be curious and eager to learn. That one at least has stood me in good stead. You have to be disciplined, and that really means self-control. So Graham drew a key distinction between investment and speculation. This paragraph, I think every investor should memorize. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. And then he defines each of these terms. Thorough analysis, the study of the facts in the light of established standards of safety and value. So you have to work at it. Safety of principal, protection against loss under all normal or reasonably likely conditions or variations. And here I want to emphasize, he's not saying that the asset you're analyzing can't lose money. What he's saying is you should be very confident, based on evidence, that the business risk is minimal, that you're not buying into a company or a market or an asset class that will simply go away. You're not going to lose 90% of your money or more because you didn't foresee an obvious flaw in the business model or the valuation. And you know, a really simple example from the headlines of the past few months would be Valiant Pharmaceuticals, which really built its business on the idea of acquiring one drug company after another and then drastically raising prices immediately after the acquisition, which any number of people said probably isn't a sustainable business model, and at least based on what we've seen in recent weeks, that seems to have been borne out. And this is the most fascinating part of Graham's definition of all, I think. What does he mean by adequate, or he sometimes used the term satisfactory return? Any rate or amount of return, however low, which the investor is willing to accept, provided he acts with reasonable intelligence. So what he's really saying is when you are investing, you should ask yourself, what is the minimal rate of return I'm willing to accept to enter into this investment? And that's a very helpful way of steering people away from having unrealistic expectations, which is so often a problem. So Graham drew another really helpful distinction that I think is often overlooked. He talked about two kinds of investors, defensive and enterprising. And the conventional definition of investor, I think we've all heard it. Many of you have probably taken questionnaires that financial advisors give you, asking you how much risk you want to take or you can take. And often it breaks down into these three categories that I regard as kind of silly, actually. Conservative, moderate, and aggressive. The notion that there are, 100 million investors in the United States and only three types seems a little silly. And there's a much more basic problem, which is that it's extraordinarily difficult to measure individual risk tolerance before the risk comes home to roost. Many of you may have taken a risk tolerance questionnaire that asks you, if the stock market went down 20%, what would you do? Would you stay put? Would you buy more? Would you sell? I see people nodding. The problem is, until it goes down 20%, everyone says, oh yeah, I'd buy more. Then it goes down 20% and people sit on their hands, or it goes down 50% and they sell, or it goes down 80% and they don't buy another stock for 20 years, even though this risk tolerance questionnaire said they had plenty of tolerance. So Graham instead draws a completely different distinction, and it has nothing to do with appetite for risk or the capacity to take risk or withstand it. It's how hard you're willing to work. How interested are you? I mean, presumably everyone in this room and most of the people watching online are interested enough in investing to spend a few minutes listening to a talk. So you are probably enterprising, or at least tilting in that direction. And so Graham says, if you're defensive, what you're trying to do is avoid big mistakes, and very importantly, you don't want to work very hard at it. You don't want to spend your Saturday afternoon reading 10Ks or downloading financial documents from the SEC website, and that's fine. If you are enterprising, then you're probably willing to commit a lot of effort to investing as an enterprise. That's why he chose that word, because it is an enterprise. It's an operation. Graham called it an operation. It's work. And for people who enjoy it, it's a lot of fun. It's enormously challenging. The critical observation here is it doesn't matter whether you're defensive or enterprising. What matters is that you know which one you are. If you are defensive, but you think you're enterprising, you're going to be very sorry. If you're enterprising and you think you're defensive, you'll be disappointed because you won't have done as well as you could in bull markets, and you probably will be disappointed in bear markets as well. So, for people who are defensive, a simple portfolio of index funds that you never touch and never trade is perfect. Totally defensible decision. If you're enterprising, that was not going to be very satisfying. And the virtue of all of this is, unlike the conventional way of separating investors, this is very easy to measure. Everyone intuitively knows how interested am I in investing as a process. So another very powerful idea for Graham is the margin of safety, and I'll summarize it in a very simple way, which is just this, that most people, most individual investors ask themselves, how much money will I make when I'm right? And this is particularly among men. This is a very standard question. Now, on Graham's terms, the intelligent investor instead will ask, or in addition, will also ask, how much money will I lose if I'm wrong? That forces you to focus on your margin of safety. Then just a couple of quick distinctions here. So all of us in this room are individual investors. Most people watching online are also, and we've been told for our entire lives that we can't compete with big institutions like mutual funds and hedge funds and pension plans insurance companies, banks, all the other professional investors with millions of dollars worth of research and resources, high-frequency trading platforms unavailable to us. And there is a counter ideology that you often hear, which is that individual investors can beat the pros at their own game. If you just are faster and smarter, and you heard this a lot in the 1990s, it's been cropping up a lot again lately, but I would ask an entirely different question, which is, why would you want to play that game? The pros can't even win that game. You know, every year, typically 70, 80% of all professional investors underperform the market. So why would I want to play the game that they don't even know how to win? Wouldn't it make more sense for me to play my game? And one of the reasons it's so hard for professional investors to win is because of the way victory is defined. So they have to measure success by how they do relative to a market benchmark, like the S&P 500, and short term. How are they doing year to date, over the past 12 months, 6 months, 3 months, 1 month, week? Often, many of them measure their results daily. And that leads to an obsession with the short term and a complete myopia for the long term. But how would individual investors, how should you measure success? It seems pretty obvious to me, instead of measuring your success relative to the S&P 500, who cares, right? And instead of measuring it short term, just measure it against what you're trying to achieve, which probably isn't beating the S&P 500 and certainly isn't beating it over the past 60 days or 60 minutes. Many of you have probably read the wonderful Richard Feynman book, What Do You Care What Other People Think, which I love, but I also love the title of the book. It's such a helpful reminder. Why would I care whether I'm beating the market? That doesn't make me richer or poorer. If I want to match the market, I can do it for almost free with an index fund. Maybe I have other goals. But certainly, measuring my success by what other people are doing is not something I'm interested in, and I don't think anybody should be. And one of the critical advantages for individuals is how long your time horizon can and should be. I mean, many of you are young. You're in your 20s, your 30s. Those decades are well behind me, but I measure my time horizon in centuries. I often say I'm investing for the next 100 years because I have children, I have causes I care about, and I'm not going to be able to build a long-term legacy with my family's wealth if I focus on what's happening today, this hour, this minute. So here are two wonderful things that Graham said. This is from The Intelligent Investor, and it's so important I will read it out loud. But note this important fact. The true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. By suits his book, Graham is using the old-fashioned Wall Street term for your interim profits and losses. Thus, and I highlighted this in red, thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man, and of course Graham was writing in the 70s, we could say that investor would be better off if his or her stocks had no market quotation at all, for the investor would then be spared the mental anguish caused him by other persons' mistakes of judgment. And Graham often used the term quotational loss to describe what happens when there's an interim decline in the market. So think about what he's saying here. What he's saying is that as an individual, rather than an institution, you have this massive advantage of not needing to care about what the market is doing in the short term. And if you do care, you have taken your biggest advantage over the institutions and turned it into a crippling disadvantage. Because what you've done is you've shifted yourself from playing your own game on your own playing field or pitch to playing their game, which they can't win and you surely can't win because you don't have the resources they do. Not that it would help them win either. So then Graham said later, in 1974, we have heard many complaints that institutional dominance of the stock market has put the small investor at a disadvantage because he can't compete. The facts are quite the opposite. I am convinced that an individual investor with sound principles and soundly advised can do distinctly better over the long pull than a large institution, where the trust company, which of course today we would think of as a mutual fund company or maybe a broker or investment bank, may have to combine its operations to 300 concerns or less, the biggest companies in the country or the world. The individual has up to 3,000 issues for his investigations and choice. Most true bargains are not available in large blocks. By this very fact, the institutions are well nigh eliminated as competitors of the bargain hunter. So what he's really saying is not only can individuals do well competing against institutions, but there's some reason to believe if your head is in the right place, you could do even better. So what do I take away from all of this? The first is just to emphasize the point Graham was just making, which is you need to position yourself, if you are an enterprising investor, you need to ask, where can I go where the big institutions can't? And one obvious choice would be stocks that are smaller than average. Another would be, just for lack of a complex term, stinker stocks. Companies that have done terribly lately, that professional investors are throwing out of their portfolios. They're throwing them overboard as fast as they can, creating value for the future. Stocks that are hard to understand. You may, as engineers or quantitatively inclined people, be able to fight your way through a prospectus better than a lot of professional investors. Another way to be intelligent is to be patient, extend your time horizon, years and decades, as I mentioned, be independent. And there's a wonderful passage from Graham, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and your reasoning are right. One of Warren Buffett's favorite passages for good reason. And then there's a wonderful saying from Ralph Waldo Emerson, the essayist and philosopher that I love. It is easy in the world to live after the world's opinion. It is easy in solitude to live after our own. But the great man, the great investor, is the one who in the midst of the crowd keeps with perfect sweetness the independence of solitude. And I wouldn't recommend this in the workplace or at home as a way to get along with your family. But as an investing philosophy, it's absolutely brilliant. And if you look at the careers of the world's greatest investors, people like Graham or Warren Buffett or Charlie Munger, you very much see this kind of mentality at work. People who separate themselves from the prevailing tides of emotion in the marketplace. When other people are euphoric, they find that troubling. When other people are miserable, they find that exciting. And the only way you can do that is with this kind of emotional detachment. So thank you. I would love to take some questions.
Thank you, Jay. This was fantastic. Folks, if you have questions, just raise your hands and I'll pass on the mic.
Yes, I'll take this one first.
Yeah, thank you.
If you don't mind.
Thank you. Very great, entertaining presentation. But you know, one issue we have, I think, even other people here within the picking stocks is that we don't really believe that we can actually pick stocks that not gonna go out of business.
Right.
Like, see, it's very great, like you're saying. So where is this stock that I know for sure if it goes down, I'm gonna buy more? I mean, like, it's even IBM is not like that anymore. Like, there's no blue chips or no. If we go to small stocks, like we don't like it be arrogant to believe that we can investigate their annual reports, their management. They could be lying in their reports. So that's why I guess maybe we should just declare ourselves defensive investors and go with the index, because you know the index not gonna go to zero, right?
So we hope.
But if you can, but if you can say maybe if you know, well, which were the stocks that maybe the large caps that we know that Benjamin Graham used to kind of invest his core portfolio? Was it like the Standard Oil or whatever was at that time? And kind of what do you think could be equivalent this time, or kind of just to?
Yeah. Well, thank you for that, and I think you largely answered your own question. I think the critical factor for everyone is to be well calibrated. You need to know about yourself how defensive or how enterprising am I prepared to be, and how qualified do I feel to become enterprising. If you're not comfortable with it, or you've done a reasonable analysis and you can't get comfortable that you could ever assess the probabilities, then you should stay defensive. Now, being defensive in Graham's terms doesn't mean that your portfolio should all be cash. It just means you're not going to analyze individual securities. You could put all your money in stocks if you wanted to, and putting it in index funds is a perfectly defensible choice, and a classic defensive choice. I would add one thing, I think, which is that both Warren Buffett and Charlie Munger, his partner, have often talked about the importance of combining patience with what Charlie Munger likes to call gumption, extreme determination at the right moment. And if you have the sort of temperament where in a period like the fourth quarter of 2008 or the first quarter of 2009, you can say, I don't think the world is coming to an end. I think financial assets are cheap. I'm going to add more. So one way you can be enterprising is you could be enterprising with a defensive portfolio. You could say the next time there's a financial crisis or a crash, and there will be one, probably sooner rather than later, although I have no idea when, but the next time there's a market panic, you could say, I'm going to add a substantial amount of money to my portfolio. Now, you don't have to do that, and the next crash might be the final crash, and it might turn out not to be a good idea. But if history is any guide, people who take that step in times of extreme disruption tend to do very well in the long run. I think we had another question here.
Yeah, thank you for coming today, Jason.
Thank you.
Just had a question. Who do you think are the Benjamin Grahams and Warren Buffetts of the 21st century? Your top three candidates, in your opinion?
Oh, boy. I'm not sure I want to go on record with that, actually. Yeah, well, no, I don't know that would make a difference. I think it's really important to be humble about anybody's ability to identify skilled managers in advance. And there certainly are plenty of people out there who are building great track records right now. But the amount of statistical analysis you have to do on their performance to have any confidence that it isn't just luck is really significant. And in most cases, what we have is reputation that has gone largely unanalyzed. And there are not that many managers whose records I've really statistically analyzed yet. Because typically by the time I get ready to do that, their performance has deteriorated. So I think I'm going to, maybe talk to me afterwards, but for now I'm going to pass. It's a really interesting question, but I'm going to pass on that one for now.
Thank you, Jason, for a great, insightful presentation. I have a two-part question, if it's okay. One is a follow-up on the question that was just asked. If you were asked the same question in the 70s and 80s, would you have named Buffett at that time, or would you not have for the exact same reason? And if you would have, why would you have?
Yeah. I think in the 70s, very few people would have named Warren Buffett. And that was a really interesting, useful lesson in that. You know, in many cases, just given the standard margins of outperformance we tend to observe in the stock market, where someone who outperforms a benchmark like the S&P 500 by 1 percentage point a year compounded is regarded as an extraordinary achievement. So, you know, over a period when stocks are up 7 or 8%, someone who earns 8 or 9 gets an enormous amount of favorable attention. It's a pretty narrow margin. And then given the standard deviation that is usually embedded in a track record like that, often you need 50 to 80 years to have 95% confidence that the person is skillful and not lucky. And at that point, you've pretty much dealt with a human lifespan, your own and the money manager. So there's kind of a paradox that by the time you can be confident that the person is really good at what he or she is doing, you're both about to die. So I don't think most people would have identified Buffett in the 70s. Quite a few did in the 1980s. Carol Loomis, the great financial journalist at Fortune, identified him almost immediately when she met him in the 60s. Carol is a good friend of mine, and some other people did as well, but most people who've invested in Berkshire Hathaway arrived later. The ones who made the most money from Berkshire are the ones who identified him earliest.
So second question, during your presentation you referred to one specific example where investors had a principal, loss of principal Valiant. When I look at the 13 Fs, there's quite a few renowned value investors, some mutual funds that go back all the way to the 70s, that Buffett in the 70s talked highly about. Some hedge funds, some that actually worked with Buffett in Geico. So a lot of past successes. What do you think, in your opinion, were errors of judgment here, obviously looking in hindsight? And then were there lessons that one could have learned from, say, something like investigative journalism that maybe the investors didn't apply to dig deeper?
Yeah, I think the recent collapse in the stock price at Valiant Pharmaceuticals is going to be a case study for years to come in investing classes. And I don't think we have the full explanation yet of what the cognitive errors were, the analytical errors that professional money managers made. But I do think that what often happens in situations like this is, and I'm speaking in general terms because I haven't done any direct research on Valiant, and I haven't spoken directly about it with many of the investors you're referring to. So I'm just speculating. But I think in many cases, people rely on the assurances of management and let qualitative factors skew judgments that otherwise would be quantitatively based. And when, as an investor, you always have to be very sensitive to retroactive revisions of the reason you own a security. If originally you invested based on quantitative measures and you now find that you're using qualitative justifications for continuing to hold it, then that is a red flag. And certainly one of the things I've learned over the past decade is the importance of having a structured decision process and working off a checklist or another template that compels you to organize your thinking and your rationale. And it also makes it harder for you to migrate away from that over time. And I think what we'll learn with hindsight is that many of these investors bought the stock for one set of reasons and then held it for a different set. And that is always a red flag in investing, as it is in a lot of other things in life. I mean, someone who married a spouse for one set of reasons and then stays with the spouse for another set is probably not likely to have a very happy marriage. And the same thing applies in the financial world, I think. Yes?
Yeah, I noticed you have a lot of comments about marriage, and I'm wondering if, your wife is going to be watching this. But yeah, we have time for one last question. So.
Thank you so much for a great talk.
Oh, you're welcome.
My question is on the definition of potential conflict of interest.
Yes.
In managing other people's money. Do you see any model that is not has the potential of conflict of interest? What do you think about, and then follow up on it, what do you think about the VC model where they charge management 20% on the profit?
Right. Well, there are many groups in the asset management business who will tell you that they have no conflict of interest. In fact, I had a long email dialogue about a year ago with a financial advisor who said to me, my financial planning practice is conflict-free. I have no conflicts of interest at all. Just ask my clients. And I tried to point out to him that, in fact, no matter how he charges, he can't help but have conflicts of interest. In fact, if he didn't charge at all, he would still have a conflict. There's an irreducible conflict in the fact that someone who's managing your money is managing your money, not his or her own. And I don't think there's any way to eliminate that. The key is for the asset manager and the client to be on the same page and to understand where the conflicts are and what the conflicts are. So someone who's charging, for example, 2 and 20 as a hedge fund might, or some VC funds might, has a clear incentive to raise money, hang on to the money, often take very substantial risks. And one of the things you want to look for, and again, this is just a bit of general advice, is as engineers, you're very familiar with this sort of approach. You want to look at the dispersion, right? You want to say, well, who out there is doing this more cheaply, and what does it look like over at this end of the distribution? And then who's doing it much more expensively, and what does that look like? And then where in that continuum does this person or fund fall, and am I comfortable with that? Is there a better, cheaper way to do it? Or do the results seem to be improved by higher fees? I mean, I guess it's theoretically possible. But certainly what you want to do is you want to look at the alternative ways that you could be charged and ask yourself whether you're more comfortable with one of those other models of paying fees rather than this one. You don't have to pay 2 and 20 if you don't want to. You might get stuck doing it if you like the people or the process, but I don't think you should accept any fee structure as a given or set in stone. There's a diversity of ways people will charge to manage your money. And I think also individual investors tend to underestimate their own negotiating power. You should always get the Form ADV, which is the standard SEC disclosure that any registered investment advisor has to provide. And often when you read the ADV, you will see something very interesting that the person you met with never mentioned. Our fees are negotiable. Very few asset managers will volunteer that fact, but by law, if they may negotiate, they must say they negotiate in the disclosure form. They don't have to tell you directly, but they do have to tell you in the disclosure form. And if you see it there, you should bring it with you when you meet with the person. So I would just encourage you to be as aggressive on that front as you're comfortable being, because fees are the primary determinant of the difference between good performance and great performance. And it's one thing that you can control, probably much more so than you've been led to believe. So I would just encourage that.
Fantastic. This was great, and I really do hope that when your book on marriage is out, that you visit us again.
I'll bring my wife.
All right. Thank you so much.
All right. Thank you. My pleasure.